Hello everyone, welcome to your first lesson in the Comex Pro course. In this lesson, we'll be covering stocks, markets, and trading. So I hope you're doing well. Let's get into it. So let's get started. You heard the term stock. What are we referring to when we talk about stocks? A stock is also known as an equity, and it's a security that represents the ownership of a fraction of the issuing company. Units of stock are called shares, which entitles the owner to a proportion of the company's assets and profits based on how much they own. Stocks are bought and sold predominantly on stock exchanges, or sometimes called stock markets, and are the foundation of many individual investors' portfolios. So, what is a stock market or exchange? The term stock market refers to several exchanges in which shares of publicly held companies are bought and sold. In the US market, the leading exchanges are the New York Stock Exchange, or the NYSE, and the Nasdaq. These are the most liquid exchanges in the world and home to some of the top company shares such as Apple, Microsoft, Amazon, and Walmart. So, how is the price of a stock calculated? The price of a stock is determined by market forces of supply and demand. When a company goes public, it undergoes a valuation during an initial public offering, or an IPO. This is where its assets, liabilities, and financials are taken into consideration as the company seeks to raise capital at this price. After this event, the total value of the company is determined. Dividing this total value by the number of issued stocks gives you the price of a single share. So after the stock begins trading, that is its IPO day, the market forces then decide its price, with buyers and sellers expressing their view through price and price action. It's important to note though that the stock price is not the same as the intrinsic value of the company. The intrinsic value is the value of the company based on its assets, liabilities, and future earnings potential. The stock price can be higher or lower than the intrinsic value depending on the market forces of supply and demand. So, when we talk about stocks, we often hear the terms short-term trading and investing. Well, what exactly is short-term trading and how does it differ from investing? Let's start with investing. Long-term investing is a strategy of investing that aims to achieve long-term growth and income by holding a portfolio of securities with a time horizon of usually 1 year or more. Long-term investors are less concerned about short-term fluctuations in price and are more focused on the long-term potential of their investments. So now let's take a look at what short-term trading is and what it involves. Short-term trading, or for short, just trading, is a type of trading that involves opening and closing of positions within a short time frame. This can range from seconds to days. Short-term traders aim to profit from small price movements in the market rather than the long-term growth of the asset. So now that we understand what trading is, let's talk about who participates in that and who trades stocks. We have three main players. We have large financial institutions that act as intermediaries. The stock market is primarily moved by multiple large financial institutions that act as intermediaries for their clients by buying and selling these shares on the market. They comprise majority of the volume. And also large financial institutions that act on their own behalf to seize opportunities in the market. These institutions transact in large volumes, moving billions of dollars in the US markets daily. And then we have retail investors. Retail investors and traders alike also participate in the market through their brokers. However, they account for a very small percentage of the market and typically don't move the markets. So as we said before, large financial institutions are the major movers of the stock market. So now that we've covered the participants of the stock market, the different stock markets, let's talk about the operating hours of the US stock market. The regular trading hours, or sometimes called the cash trading hours for the US stock market, which includes both the Nasdaq and the New York Stock Exchange, are 9:30 a.m. to 4 p.m. Eastern Standard Time, and that is Monday through Friday. We also have other trading hours, which are non-cash trading hours. These are the pre-market, and this begins at 8 a.m. Eastern Standard Time and generally has limited volume and liquidity, and therefore large bid-ask spreads. And also after hours, so that's after cash trading has ended, and that starts at 4:01 p.m. and continues to 8 p.m., which again has limited volume and liquidity. So oftentimes you'll hear the term gaps, and this is something very important to note, as this is how the stock market measures stock price data on a daily basis. So the daily performance of stocks are measured based on the regular trading hours from 9:30 a.m. to 4 p.m. For example, when a stock is said to be starting a day up 5%, this is the difference between the close price at 4 p.m. the previous day and the opening price at 9:30 a.m. the next day. And this is what we called the gap. This is the difference between the closing price and the opening price the next day. Therefore, you'll often hear the term "it gapped up" when a stock is opening higher the next day, or "it gapped down" when a stock is opening lower the next day. These gaps are also reflected on the daily charts, something we'll cover in future lessons. So another aspect of the stock markets is volatility. What exactly is volatility? This will play a huge role in how stock markets move. Well, volatility is a statistical measure of daily returns in a market. The US stock market is one of the most volatile stock markets in the world. In the stock market, volatility is often associated with big price swings. For example, when the stock market rises and falls more than 1% over a trading day, it's called a volatile market. Overall, long-term investors, in quotations, hate volatile markets, while short-term traders and investors love volatile markets. This explanation is that long-term investors can weigh a 0.1% move daily for 200 days, giving them a 20% plus return, while short-term traders favor fast and quick returns and like to know that the market will move and adjust appropriately. And that's it for this first lesson, traders. Thank you for tuning in and looking forward to seeing you in the next lesson. Take care and bye for now.